Well, it's been a very strange past week for markets and around the world. So what does this week have in store? Hi everyone, welcome to the Traders Circle weekly market update. Today is Tuesday, the 10th of October 2023. And before I get into it, you do need to be aware that anything I say is general advice only. So it doesn't consider your personal financial circumstances, and you have to decide whether it's appropriate for you. So last Friday we saw US unemployment data, and unemployment actually rose. It came out higher than expected, which obviously is not a good thing. It's not a good thing for the economy. It's not a good thing for society. No one wants to see people lose their jobs, but it was a good thing for the market. And after the unemployment read came out, US markets actually pushed higher, and they continued higher overnight. Now, why is that the case? Well, rising unemployment is seen as deflationary. When unemployment rises, it's seen that there's less likelihood of further interest rate rises. So bond yields came down, rate bets came down, and the market basically took this and went, well, we've seen unemployment fall. Does that mean that interest rates aren't going to go any higher? So markets are now starting to question the comments of the Fed earlier in September, where the Fed was basically stating that they think there's going to be another rate rise and that rate rises are going to remain higher for longer. And then on Friday night with the unemployment, investors are going, oh, maybe the Fed has got it wrong. Maybe they won't actually raise rates further. Maybe rates are peaking, and maybe, we're going to see rate cuts sooner than they were suggesting as well. So that unemployment read, though it's not a good thing for people to lose their jobs, the market really lapped it up. The market basically saw it as a sign that, the economy is weakening, rate rises are less likely, and, before too long, we'll be seeing rate cuts. So it was really that unemployment read that triggered the rebound in shares that we've seen across the past 3 or 4 sessions. Now, all this is just speculation because the main event will actually be the inflation data, the CPI data, and that will come from the US on Thursday night Australian time. So, if unemployment rises, it kind of does sort of reduce the bets on sort of interest rates and inflation going up. But, that could all be shattered if the CPI growth is strong still at that reading. Now, the expectations are for a fairly flat CPI growth reading, and I think that's what the market wants to see. There have been some fairly inflationary events across the past couple of months, especially with oil prices going up. But if inflation or CPI growth doesn't rise, I think the market will take that as a sign that, it is over a longer term period continuing to come down, that inflation is starting to slow and is getting under control, and that we are, again, perhaps already at peak interest rates. Now, the real risk from this CPI reading is if it comes in higher than expected. If that CPI growth reading is higher than expected, I think we're very likely to see a renewed round of selling, not just in US markets, but in Australian markets and, in all global, particularly Western stock markets. It's a little different in emerging countries and particularly China. China probably wants to see more inflation. They've got fairly lackluster CPI growth numbers at the moment. So that'll be a main event for US markets. That's going to occur on Thursday night. There are a handful of other significant events in the US this week. We are going to see producer prices on Wednesday night, and we are going to see the start of their company earnings reporting season. That really starts in earnest on Thursday as well. This company earnings reporting season, it's expected to show a fairly strong drop in company earnings. It's kind of hard to gauge what effect that will have on the market because, like I said, the market does want to see an economic slowdown, but they don't necessarily want to see their stocks earning less. So it'll be very, very hard for investors to rationalize, a big earnings slowdown and, potentially the market going up. So I think mostly it's going to come down to the forward guidance, just how rosy that forward guidance is, whether or not they, suggest that there's going to be an earnings collapse next year, whether or not they sort of start downsizing their business and sort of trying to increase margins and profitability and things like that. So I think the forward guidance is going to be the key event with the company earnings reporting. Finally, this week or over the weekend, we did see an escalation in the Israel-Palestine conflict. We're certainly not a political channel or a conflict channel, so we don't have any sort of bold or interesting takes there other than, no one wants to see conflict or anything of that nature. This conflict did push up oil prices initially, and historically, wars, particularly in this part of the world, have pushed up oil prices. And that's probably not a good thing for stock markets at the moment, or certainly not a good thing for stock markets at the moment. It feels very callous to talk about it from a market perspective, but unfortunately, that's what this channel's about. It has pushed up oil prices initially. That's not great for the stock market. If oil prices continue higher from here, that'll be another inflationary pressure on the market, and it could again lead to that additional interest rate rise that investors are weighing up towards the end of this year. So what we'll be sort of keeping an eye on is whether oil continues higher from here, whether there's interruptions to Iranian supply, for example, or other countries' supply from that part of the world, and whether oil prices take another significant jump after the jump they had on Monday. So tragic situation, but we hate to sort of come back to the market, but if you are bullish this market, you'll be hoping that oil doesn't advance any further than the current levels. And, that'll be the key element to watch from a market perspective moving forwards. Looking at the charts, this is the Australian Top 200 Index. We can see that late last week, we sort of bottomed out around 6,900 index points. And then after that US unemployment read, we've really pushed up strongly. We were set to rise quite strongly yesterday, but with the events over the weekend, we were a little unsure, and we waited for the US movement overnight. The US was up, and we had our sort of bullish move today. So we popped back above the key 7,000 level, but we didn't get too far off the next key level, around 70.80. It's roughly 70.70 to 7,100. There's plenty of resistance in that range, and I suspect that'll be the cap on our current move, at least until the US CPI reading on Thursday night. Overall, we are in a downwards movement over the short and medium term. If we can get through 7,100, I suspect the key target is not too far away, probably just under 7,200 index points at this rough downtrend line. For the past sort of more than a year or so, we've been in a broad sideways channel, and we are towards the lower bound of that channel at the moment. So unless something changes, we probably would expect to sort of fluctuate around these levels as we wait for a clearer narrative to form around inflation and whether or not we have seen an end to the US interest rate rises. For our own interest rate rises, we're very, very likely to see at least one more by the end of the year, and that's possibly going to come at the November meeting, although we'll have to wait and see how the sort of RBA shuffles things around between now and then. But yeah, likely Australia will see one more regardless. It's just whether there's going to be another US rate rise. So at the moment, we have had a bit of a bullish bounce, but the resistance isn't too far away. And like I said, even if we break 7,100, I wouldn't bank on too much more than this downtrend line here, 7,150, 7,180, somewhere around there. Looking over at the US markets, they did also bounce quite a bit after the unemployment data on Friday. They came up to the next resistance level at 43.35. And then they closed right at that level overnight. So they didn't have the momentum to get through that level. Now they are rising off a longer term uptrend. They are rising off the 200-day moving average. And these are generally pretty key levels where you might see a bounce. But just for the time being, they haven't had enough bullish momentum to break that first resistance level. Now, if they do, there's plenty of other levels that may cap their movement. The first would be 4,400, and then you've got a potential downtrend line not far above that. Again, it's very hard to see US markets breaking significantly higher until Thursday night's CPI reading. So I suspect we're going to just trade around the current levels, maybe even back down a little bit until they get that inflation data and until they start to price in either an interest rate peak or another interest rate rise. Alright guys, I will leave it there for this week. It's a little bit of a somber one. Hopefully you enjoyed regardless, or at the very least got something out of it. If you did, let us know in the comments. Click like, click subscribe, and we'll see you next time.